In 1984, inflation in Israel reached 445%. Currency value deteriorated faster than the tax system could respond. Direct taxation suffered from bracket creep and revenue lag. Real collections declined despite rising nominal income. Fiscal predictability weakened. The solution was structural, a tax collected at the point of transaction. Value-added tax.
We'll break down how it helped rescue an economy on the very brink of collapse, how it actually functions today, and maybe most importantly, how it's now transforming into this powerful, real-time tool for state control. All right, we've structured this briefing into 4 key parts. First, we'll set the stage with the pre-VAT crisis. Then, we'll examine VAT as the stabilizing solution that was brought in. From there, we'll look at the modern compliance framework for businesses, and finally, we'll analyze the huge shift towards digitization and real-time control. All right, let's dive into our first section, the pre-VAT crisis. You see, to really understand the logic behind Israel's VAT, you have to go back and examine the macroeconomic pressures that made this kind of radical reform an absolute national necessity. The system they had before was, and this is no exaggeration, on the brink of collapse. Israel's initial tax framework was actually inherited from the British Mandate, and it was centered on direct income taxes. So after 1948, the new state relied heavily on these direct taxes, along with customs duties, to fund everything: immense national projects, defense, you name it. But the pressures just kept mounting, especially after the 1973 war and the global oil crisis. This combination triggered a severe fiscal instability that eventually led to runaway inflation. So just how severe was this instability? Well, think about this. In 1984 alone, the annual inflation rate reached a staggering 445%. That level of hyperinflation makes an economy fundamentally unstable. It makes traditional tax collection almost impossible. And this quote right here, it really highlights the core problem. Because of the time lag between when income was earned and when the tax on it was actually collected, the real value of the government's revenue was just destroyed by inflation. The state was effectively chasing a moving target with a currency that was devaluing by the day. This crisis leads us directly to Section 2, the VAT solution. The government's response was a really strategic pivot away from that unstable income-based system to a much more resilient, consumption-based model, one designed specifically to withstand these kinds of inflationary shocks. So, value-added tax was introduced in 1976. At its core, it's a consumption tax that's applied at each stage of the supply chain whenever value is added. The genius of it was that by taxing transactions as they happened, it created this broad inflation-resistant tax base that automatically tracked current prices. Now, this next slide shows an absolutely critical distinction in how that works: zero-rated versus exempt. Let's break this down carefully. For a zero-rated good, like something being exported, the business charges 0% VAT. But crucially, it can still reclaim all the input VAT it paid on its costs. This is vital for staying competitive internationally. In contrast, for an exempt service, no VAT is charged on the sale, but, and this is the key, the business cannot recover the VAT it paid on its inputs. That tax just becomes an embedded, unrecoverable cost for the business. The standard VAT rate itself has, of course, evolved quite a bit. It started out at a pretty modest 8% back in 1976. More recently, it's been steady at 17%, and in an effort to bolster state revenue, it's been legislated to rise to 18% starting in 2025. Okay, so that's the theory and the history. This brings us to Section 3, the modern compliance framework. Let's take a look at how businesses operating in Israel today actually navigate the practical realities of this system. For the most part, businesses register in one of 2 ways. You have an Osek Patur or an exempt dealer. This is for small businesses with a turnover of up to 120,000 shekels. They don't charge VAT, but remember, they also can't reclaim their input VAT. On the other side, you have an Osek Murshe, or authorized dealer. This is for larger businesses. They must charge the standard VAT rate and file regular returns, and this allows them to fully recover their input VAT. Now, to simplify the income tax side of things, there's something called the Osek Zair status. It is absolutely crucial to understand that this is an income tax classification. It is not a separate VAT registration. It's a tool that allows individuals earning under that 120,000 shekel threshold to take an automatic 30% deduction for their expenses, which really streamlines their tax filing. However, that simplified Osek Patur status isn't available to everyone. Certain professions, and you can see a list here, lawyers, doctors, accountants, engineers, they are all required by law to register as an Osek Murshe from day one, no matter what their income level is. And that leads us to our final section, which is really about where the system is headed. Section 4, digitization and real-time control. This is all about the Israel Invoices reform, which is a fundamental shift in tax enforcement, and it's all powered by technology. You know, the strategic question that's driving this whole reform is this: how does a state combat things like invoice fraud and the shadow economy, not after the fact, but as it's happening in real time? The traditional model of doing an audit later is reactive. This new model aims to be preventative. And the solution is a model called Continuous Transaction Controls, or CTC. Under this system, the tax authority has to validate business-to-business invoice data in real time. The crucial part is this: a buyer is legally prohibited from deducting their input VAT without a state-issued approval number. This essentially embeds the tax authority directly into the transaction workflow. The rollout of this system has been dramatically accelerated. The threshold for mandatory e-invoicing started at 25,000 shekels in May of 2024. It then drops to 20,000 in January 2025, then down to 10,000 in January 2026, and finally all the way down to just 5,000 shekels by June of 2026. Let's just pause and put that final number into perspective. By mid-2026, any business-to-business invoice over just 5,000 shekels, which is a relatively low amount, will require a real-time allocation number directly from the tax authority before it can even be processed. So here's how the mandatory workflow actually operates. First, the supplier's system sends the invoice data to the tax authority's platform through an API. Second, the authority system reviews it instantly and issues a unique allocation number. Third, the supplier must include that number on the final invoice. And fourth, the buyer verifies the number, and then, and only then, can they legally deduct the input VAT. And this quote right here, it reveals the true strategic logic of the system's design. It says, this effectively turns the buyer into an enforcement agent for the state. You see, the buyer is now powerfully incentivized to make sure the seller is compliant, because their own ability to deduct VAT depends entirely on it. So we'll leave you with this final thought. As fiscal authorities, not just in Israel, but around the world, integrate themselves deeper and deeper into the flow of real-time commerce, we really have to consider the ultimate balance. What is the right equilibrium between the state's very real need for revenue security and the operational friction this inevitably places upon businesses? It's a question that is going to define the future of taxation.